Precious metals continue to push higher. Energy has recently turned around, and the economic picture looks a little different than it did just a few weeks ago. After a summer of stagflationary concerns, the fourth quarter is shaping up for growth and what we would call reflation. Today, we'll break down the latest economic data, some important policy risks, and what it all means for investors seeking to steward their wealth wisely. Welcome to episode 9 of the Wealth and Wisdom Podcast, where intentional planning meets eternal perspective. It is September 29th, 2025, and I am so glad you're here. My name is Cole Leonida with John Moore Associates, where we help successful and generous families navigate the intersection of financial planning and biblical wisdom. Now, I'm flying solo today. Brian himself is on a flight on the way to Arizona to join the cool kids for the week, so you are stuck with me just for this one episode. But don't worry, I've got a lot to cover as we look at economy, policy, and markets through the lens of biblical stewardship. So why don't we dive right in and take a look at the macroeconomic update for the week. Last week, we got the GDP, or the gross domestic product, for second quarter. That was revised up all the way to 3.8% annualized. And this was a big uptick. But the bigger story here is what's ahead. We will still need to get the third quarter numbers. We've flagged a lot of economic data, though it wasn't the GDP number. That always lags by a little bit. We flagged a lot, especially in the labor market and with the consumer, that is pointing to a bit of a slowdown, and the projections are showing that as well. We're seeing somewhere in the 1.5% range as the early projections on what Q3 will come out as. We've already kind of identified that. This has been that stagflation where we've seen inflation accelerating. We've seen growth seemingly decelerate, slow down a little bit, though it hasn't been negative. We have seen a slowdown relative to what we've seen in first and second quarter. That leads to stagflation. We've kind of seen trades within the markets that have supported that as well. There's been certain areas that have benefited from this stagflationary environment. But looking into fourth quarter, coming off of what we think will be a lower growth number in Q3, Q4, Q1 of 2026, and Q2 of 2026 are looking very positive on the growth front, and that is generally a good thing for risk assets. We're also seeing the labor market. We got some data last week. Jobless claims remain fairly steady. Payroll growth is slowing a little bit, though it's not collapsing. This is just a deceleration. This was not as noticeable of a shift as we saw a couple of weeks ago before the Fed cut rates. But the labor market is still a point of emphasis for future rate decisions, as well as what we are seeing in the economy. Now, the consumer is still, as they say, resilient. Incomes are rising modestly, but with inflation, spending power has been pretty flat. It's been pretty tight, and we've talked about this K-shaped recovery in our investment committee, where the upper end, the top leg of the K, those high-income earners, the people with assets that have experienced the appreciation over the last couple of years, those folks are not feeling the pinch of inflation like that bottom leg of the K. So we're seeing kind of a divergence or a bifurcation of our economy where essentially the rich are getting richer and the poor are getting poorer. They're feeling that pinch. But when you aggregate it all together, because so much of our economy is driven, the consumer spending drives the economy, and that is driven by that upward, that higher leg of the K. So when it all filters out into our numbers that we get, it doesn't look that bad, though there's a lot of Americans that are struggling on that lower leg of the K. So we're seeing that bifurcation of the economy, and that's really challenging to see. But what it means overall is that the economy is still kind of humming along. For all intents and purposes, the economy is doing just fine, though many families don't feel like they're doing just fine. They're feeling a little bit stressed. Housing, we got some big housing data where we saw new home sales absolutely blow it out last month. They were up 20% month over month. This was way higher than expected, and just a dramatic acceleration on the new home sales, though existing home sales were down about 0.2%. 3%, though that was not as bad as expected. So some good and some bad there. The thought there is that potentially on the new home sale side, they're able to offer some discounted rates when they're doing financing to incentivize people to purchase the newer homes. But existing homes, people are kind of stuck there because rates are still high in most markets around the country. Prices are still incredibly high, so people are kind of stuck in those lower mortgages that they had. They can't go buy, they can't put their existing home on the market to go buy a new one unless they can get some kind of discount on a rate or a price through a new home sale. That's the theory on why there was such a discrepancy between the housing numbers last month. But what we really reflected on is Proverbs 27 verse 23. It says, "Be sure you know the condition of your flocks. Give careful attention to your herds." This is just a call to awareness that we wanted to talk through today. We can't control the economy. We can't control the stock market, but we can be aware of what's going on around us so we can make wise decisions with what we're doing. In our case, with our money. Where are we paying our attention? Do we know what's going on so that we can make wise and prudent decisions moving forward? We also want to pay close attention to what's going on with government politics, policy, tax law. All of that factors in, though we don't want our politics to drive our investing decisions. We do have to pay attention to what's going on with the government. And of course, we've got a looming government shutdown that is likely to happen tomorrow on September 30th. Historically, if it does shut down, stock market doesn't generally care. Historically, it's up about 3% on average during government shutdowns. So not as big of a concern for stock market investors as one might think. What could have impact and likely will have impact is the new tariffs that are set to kick off on October 1st. We're looking at an impact of 100% tariffs on pharmaceuticals. We're looking at 25% tariffs on trucks, 30% tariffs on furniture, and 50% on cabinetry. Now, there's lots of caveats in there on who's going to be affected exactly. But those are really big tariff numbers, and they're all designed to try to pull jobs back into America. Now, whether that works out or not, time will tell. But this will add some friction to supply chains and potentially to consumer costs. Of course, this will likely have an impact, maybe not on the broader stock market, but individual stock picks could be impacted by this and likely will. We're also seeing some regulation update. Google, for one, is facing a potential breakup where they're going to have to split up, particularly on their AdSense side of things. Amazon has been fined by the FTC. There's big news around TikTok restructuring. There's a lot going on the regulatory front, and that's always a risk, especially in the big tech space, is if regulations are going to come down the pike where they're going to have to reorganize or split up. That can be a risk that you have to be aware of when you're investing in those big companies. Shifting into, I think this is a good segue to shift into markets. We had our first down week in several weeks on the S&P 500, the NASDAQ. They were all down. The S&P was down about 0.3% last week, though it could have been a lot worse because Friday we had a really strong rally. 86% of stocks in the S&P 500 were up on Friday. So yes, there was a little bit of a fall and a decline last week going through Thursday, but then Friday there was a big bounce back up off of that the bottom that was put in on Thursday. 430 of the 500 stocks that make up the S&P were positive on the day on Friday. So that was kind of an interesting quick shift off of what was shaping up to be a fairly poor week last week. Ended up being kind of neutral, just down a little bit on the week. What we are seeing is that we're about 11% above our measure of the long-term trend on the stock market. We're seeing valuations that are a little bit stretched. Our JMA proprietary metric evaluation has been stretched. It's been high. Stocks have looked expensive for quite some time. And now we're looking at a forward price to earnings ratio, which is kind of a more general, broad description of valuation on the equity markets. at about 22.8, and that's forward price to earnings ratio. That is historically very high. It's not the highest of all time, but it is historically high. We're also seeing a record high for price to sales multiples. So those are things to be aware of. Prices can stay, or stocks can stay expensive for a prolonged period of time. Stocks can stay what we would call overbought for a prolonged period of time. That's what can create bubbles. What we're seeing right now at 11% above trend, as we've mentioned the last few weeks, this is not what we would consider a bubble, though. Stocks do look a little bit expensive. We are a little bit above trend. That gives us a little bit of pause before we, put the pedal down and just go all in on stocks. What's been interesting, I mentioned on the very beginning at the intro that commodities, particularly precious metals, have been doing incredibly well this year. Gold, silver, and even platinum are continuing their breakout, putting in all-time highs, except for silver hasn't quite gotten there. But gold closed over, I think it was $3,800 per ounce for the first time. Platinum is breaking out as well. It's really been an incredibly strong run for precious metals. We're also seeing a potential trend reversal on energy, particularly in the oil space. We could be early on that, but it is something that we noticed, and there could be a shift happening after a little bit of a decline in oil. Energy could ramp back up, and we're kind of seeing potentially the early innings of a new trend on that. So what are we seeing overall with the market? Well, the risk backdrop here, the risk profile on the market, we're seeing the volatility index, or the VIX, still remain low. We're just in kind of the mid-teens on the VIX, which historically is low. That means it's generally a green light for equities. We're also seeing the MOVE index, which is kind of the bond market cousin of the VIX that measures volatility on bonds. That is also decelerating. It's on the way down. So that's kind of low right now as well. And so that means that there could be kind of a positive, a bull market indicator for bonds. We also see bond yields. They kind of bounced up a little bit and then hit a ceiling, and they could be on their way back down, which is going to be positive for bond prices and overall return on bonds that you already own. And then we're also seeing credit spreads start to tighten a little bit. All of these things are signaling confidence in risk assets. This is what, if I could do some industry jargon here, this would be indicative of a risk-on trade, where people are leaning into risk assets like stocks or like crypto, things like that, where this is shaping up for a positive move on those kinds of things. And from an economic standpoint, from what I already said, where growth and inflation are looking to accelerate, we're also seeing the 2026 earnings numbers, the estimates on equities throughout the stock market. Incredibly positive. We're seeing 12-13% estimates on earnings per share for the stock market. And then even better than that, the small and mid-cap companies have even higher projected earnings per share going into 2026. So all that to say, there's a lot of good news, though there's never perfect news. This is something where there's always a risk. We don't know what that could be. It could be regulatory, it could be tariffs, it could be geopolitical, or we could get some surprising data. We certainly can't predict the future. Our crystal ball is always a little bit foggy, and we try to stay out of that predictive game. But again, going back to Proverbs from earlier, we're trying to be aware of what's going on around us. When is the right time to take a little bit more risk, lean into stocks? When's the right time to raise some cash and be okay with sitting on the sidelines for a little bit? As it stands right now, we're kind of balancing the two because things look expensive. We're above trend, though the setup moving forward for the next couple of quarters is generally positive. So weighing that tension, that's where the wisdom of the group, of our investment committee, we have decades and decades of experience on that committee where we all get to share ideas and say, hey, you remember when this happened back in the 80s? We were talking about the early 70s and the early 80s during our investment committee today. It's just really insightful to hear from John Moore himself talking about the last 45 years of stock market history. And then we've got another advisor that is really kind of a lifelong learner on the precious metals and the commodity space. We've got some technical analysts on the team. We've got some more fundamentally focused advisors on the team. It's really great to get wisdom of the team and the committee before we make any kind of portfolio decisions. So the practical takeaway for today is that the economy looks like it's set up to reaccelerate going into the fourth quarter and the first half of 2026, but markets are expensive and there's some very real policy risk out there. So the best response isn't to chase performance or try to time every move of the market, but to stay diversified and disciplined. Stick to a process. Ecclesiastes 11:2, I quoted this last week as well, tells us to invest in 7 ventures, yes, in 8, for you do not know what disaster may come upon the land. We still want to remain diversified, not pushing too many eggs into one basket. That wisdom reminds us that diversification isn't just a financial principle, it's a biblical one as well. By spreading out that risk, we protect ourselves from uncertainty of any one singular outcome. And we keep our focus on that long-term stewardship, looking at ourselves as God's portfolio manager. He's entrusted a little slice of his portfolio for us. We're trying to make good on the talents that he's blessed us with. We're trying to multiply those in a wise and prudent way. So with that, I will close for today. Thanks so much for joining me solo on the Wealth and Wisdom podcast, where intentional planning meets eternal perspective. If you found today's video helpful, please like the video, subscribe to the channel, and share this with someone else who might benefit from this. And if you're looking for more resources or timely insights, visit our insights page at johnmoore.com, where we regularly share articles, videos, and tools to help you steward wisely. I look forward to seeing you all back here next week.